Hello everyone, we've been trying to figure out which way markets are going. There's some basketball and, oh, look what we've got here. Now, I promised you all that I would juggle for you in the next episode because the Australian dollar is juggling which way to go, and I think the juggling test has resulted in recognition that the Australian dollar is probably going to keep falling. So, that said, over to today's events. We had producer price inflation very clear in today's producer prices for Australia, up 0.7% on the month. That is an incredible acceleration that's been going on for several months now, and just again reiterates what I've been saying for so long. I've been saying it for months, maybe half a year. Inflation is not transitory. I also, at the very beginning, thought it was going to be transitory. But it's not going to be transitory. It's a serious problem, and all the central banks are going hands off, and the Reserve Bank of Australia seems to be going hands off just because the Fed is, without recognising that Australia didn't have, and hopefully won't have, the COVID crisis the United States had, yet we still had the same level of stimulus, or higher, per capita. So I think it's about time we certainly stopped our bond buying program, and the RBA warned the market, and particularly warned the housing market, that the next move in interest rates is going to be to the upside. So there are risks there for the economy. It is that inflation stays stronger. It is that the Delta strain situation does become more difficult to manage moving forward. We're already in lockdown for a lot of people in Australia. And it's not only that though, it's that inflation's going to be out of control because our central bank hasn't done anything, is behind the curve. So it is a real worry. It will have a serious, significant, actual economic impact. It's not an abstract economic theory that inflation is not good for an economy. In terms of price action, we've seen some significant hesitation in the NASDAQ. We've seen markets trying to eke out new highs, but really they're range trading within the total daily ranges. The close might be eking out a new high, but it's really sideways volatility. As I said, I'm still bearish to the Australian dollar. I think it might be rolling over right now, actually. And the oil's made a nice little break against my view to the upside, but I have to recognize that it has made a break to the upside. And I'd watched the lows of the last 2 days in oil, and if you were short, if you've been short, you'd probably not want to be short at the moment unless we get back below those lows. We had a very good run on the downside for oil for quite some time. My big favourite really is gold, and therefore I'm still bearish Australian dollar, so Aussie gold continues to be a real favourite of mine. I think it will continue to build. If you're not sure about my Aussie dollar forecast, I really suggest have a look at gold. It's making a long-term pennant formation which has price targets that are significantly above the market. In terms of the economic outlook, it's not good. This is going to have a big impact for Australia. In terms of the economic outlook for the US, we just had GDP there. GDP came in at a whopping 6.5%, which was only about 3/4 of what the market was expecting, 8.5%. And again, it highlights our view that the US economy is not what people think it is, that you cannot take the bounce back rates of growth and extrapolate them into future economic GDP forecasts or expectations going forward. It's a false nirvana. There isn't a nirvana economic scenario in the 12-month to 5-year horizon. What there is a hope of getting back to normal. Even after 30% of the equivalent of 30% of a normal year's GDP was pumped into the US in the last year and a half in terms of stimulus. They've had near zero interest rates, massive bond buying, and still their economy is only just now getting back to where it was in 2019. It's not as if the US economy has been streaking ahead. It's been climbing back. I would say even, clawing back. And it's back to about where it was, but there's parts of the economy that are not in good shape, such as employment. So there are sectors too that are still in trouble in the US. Obviously, hospitality is still not back to where it was. And there will be ongoing problems moving forward. I'm not saying the problems outweigh the overall trajectory of growth, but the trajectory of growth is more normal path. And you've got to remember that coming into COVID, the United States, like Australia also, was already experiencing below trend economic growth. So there were already structural problems in place. It's certainly not a Nirvana economic situation. And again, I know I've said it before, but this sucking forward of economic activity that would have occurred in 2 to 3 years' time into the present, into the last year, because everyone had time to do whatever they were thinking of doing, plus there were government incentives to do so and stimulus measures to do so. So all of that bringing forward of economic activity out of the future, the fact that stimulus measures will begin to wane, the fact that inflation's getting out of hand and that Delta is going to continue rolling supply chain disruptions around the world is not a happy, wonderful economic mix. Now, I'm a pretty happy kind of person, but I've got to say to you, the happiness comes in giving you the advance warning that it isn't going to be so great into the future as a lot of these Nirvana economic forecasts have been suggesting. That's all I'm saying to you. There is certainly downside risk to a Nirvana economic outlook at this point, and that is showing up in the US data now. Second quarter in US data, US GDP, was probably as good as it gets. It's not going to get any better than that. It's probably going to moderate from here. So already in a lot of data series in the US, we've already seen the rolling over with the peaks months ago. So Q2 GDP data is as good as it gets for now. And moving forward, expect most economists to continue to be disappointed. And that creates downside vulnerabilities for stocks. As we know, a lot of the recent gains in US stock markets were due to foreign investors buying no matter what because they were fearful about their current national situation relative to COVID. They're also fearful of inflation, so they thought the safe thing to do was to buy US stocks because they'd been going up, and so that's driven it to even greater highs, which means the eventual fall could be all much worse. So I don't want to be a pessimist, I just want to highlight that risk to you. It's Friday afternoon in Sydney. Tomorrow we get to stay home, that's very exciting. Have a great day wherever you are, and all the very best.